everyone. So I'm going to take you through these 4 concepts on building the silver bullet. Liquidity is the first concept. Without liquidity, there is no silver bullet. Without liquidity, there is no market moving. The market moves by seeking liquidity. So without liquidity, the market can't move. Second one is imbalance, represented by fair value gaps and volume imbalances. This is market structure shift. No, I mean market structure. And the fourth one is time. So the 4 must come hand in hand for market to move. So on this video, we're going to talk about liquidity. Liquidity pools are the fuels for the market movement, as they provide the necessary liquidity for large players to transact efficiently. By identifying these zones, traders can anticipate where price might be drawn and how it might behave, aligning their strategies with institutional activity. So liquidity are areas of where lots of trading activities takes place. This is because the large players in the markets come into play, and these are areas where there rests so much liquidity, such as stop losses and sell stops or buy stops. There are types of liquidity, 2 types: internal liquidity and external liquidity. Internal liquidity is marked by imbalances and inefficiencies in the market, while external liquidity is marked by swing highs and swing lows. Imbalances are represented by fair value gaps. Those are like opening range gaps, volume imbalances, and liquidity voids. So what is the price movement mechanism, or how does the market move? Price will always move from premium to discount, then back to premium, then down again to discount. So what it does is it takes internal liquidity and delivers it to the external liquidity and vice versa. And that is how it's always moving, because there's a demand and supply. When the demand is high, price moves up, and when there is high supply, the price moves down. That is, the market takes liquidity from a fair value gaps to a swing high. Then it takes the liquidity at the swing high back to the internal liquidity, which is the fair value gap, and vice versa. It is key to note when you trade like this, you are trading like the banks and the big financial institutions. You only wait until when they come into play in the market and see how they are placing their orders and following their order flow. You don't want to just be in the market when there is low liquidity. You need to be in the market when the liquidity is very high, and that is when the big financial institutions and like the banks, the hedge funds, when they're in play, when they come into the market. You have to understand that these are the people who actually move the markets, as they place very large positions. You are safer trading with them than against them. Remember, the market is always seeking liquidity. Always wait for liquidity to be taken before entering the trade. Don't beat the liquidity. So you have to wait for the big players in the market to show you where they want to take the market or price, so that you may align your strategy with them. Otherwise, you'll be just like the retail traders. The rationale behind liquidity pools trading: alignment with institutional activity. That is, market makers and institutions target liquidity pools for large trade executions. Trading at these levels aligns you with the smart money. Sharp price reaction. Liquidity pools often trigger volatility and reversals. Opportunities for precise trading entries and exits. With this strategy of liquidity trading, you are more precise because you are looking at the reversals from the initial point. Like, you are not waiting for the pattern to form, because trading a pattern is waiting for the whole move to happen so that you may see the pattern and you just take a little part of it. But when you can see the pattern forming, or even before it forms, you can take the trade from a very extreme point, like the starting point of the reversal, to the end. Yani, this strategy of liquidity trading, you are more precise on entries and exits. Enhanced risk reward ratios. That's what I mean. When you place your trade at the extreme point of the reversal, like where it starts, you have a very small risk and a very high reward. Near key supports and resistance levels for tighter stop losses and larger profit size. Yes. Avoid retail traps, because what the market is doing is seeking liquidity always. And as it seeks liquidity, the retail traders are the one who are giving the market, who are providing the market with the liquidity. So their stop losses are getting liquidated, their positions are getting liquidated. So the market is generating more money before the actual moves happen. So you have to wait for the whole trap to take place, which normally we call the Judas swing. Then you enter the position after the market have started now reversing. It also helps with predictable price movement. Prices gravitate towards liquidity pools, making market direction easier to forecast. So these are the chart examples of, let's start with the fair value gap. Yes, what is a fair value gap? A fair value gap is a 3-candle pattern where the high of the first candle does not overlap with the low of the third candle. Okay, let me say that again. This is a 3-candle pattern where the high of the first candle does not overlap with the low of the third candle. That is in an uptrend. And in a downtrend, it will be a 3-candle pattern where the low of the first of the where the high of the first candle does not overlap with the low of the third candle. Yes, I said that right. Yes, but you get the picture. It's just right here. So on the side here, we have these three big bullish candles. They're actually 4. So we count from the first after the break of structure. So that's 1, 2. You see, the wick of the first candle after the structure shift, the break of structure, does not overlap with the third after now the big candle. That's what I mean. This is caused by a rapid movement of the market in one direction. The imbalance is at a key level on the market. Let's say this again. This is caused by the rapid movement of market in one direction, resulting in an imbalance and an inefficiency. Yes, there's an imbalance. There's an inefficiency of sellers in this market, because the market is only offering the buy side, and not giving chance for the sellers to take play in the market. So we understand that the market will have to come back there and offer the sellers an opportunity to sell before continuing in the same direction. That's what you're seeing. After it has reached the top, after it has made the last big candle, the green candle, and it has started reversing. That is to offer the sellers an opportunity to sell at that level where the fair value gap happened, because that is where the actual imbalance occurred. So after it has reached there, a reversal is going to take place around that area. So you have to watch out for a market structure shift. So typically price will come back to these levels to balance this imbalance. This is where you should look for your entries. The same case applies for a bearish market. We have another chart here. It is the same chart here on a lower time frame. That's a 1 minute. So you can see the market as it moves up, it's going back, then going up, going down, then going up. It is going at these highlighted levels where the fair value gaps happen. You see, the first candle does not overlap with the third candle. So between that one candle in the middle, there is a gap. That's the fair value gap. And your entries should always be at that gap. That's the whole point. That's the whole thing I'm teaching here. That's the whole thing I'm talking about. That's the whole thing we'll be discussing. Yes, so I hope this was insightful, and I'll do the next video on what on the second concept, which was, let me see, which was imbalance. Now we'll be talking about the fair value gap. Yes, till then, have a good day and have a good time.